Did you know the American stock market is worth over $40 trillion? And most people have no idea how it works? Investing isn't just for Wall Street anymore. It's becoming a growing trend among Generation Z. In fact, the share of people ages 25 to 39 making annual transfers to investment accounts more than tripled between 2013 and 2023, reaching 14.4%, outpacing increases for those 40 and over, according to data from the J.P. Morgan Chase Institute. The stock market is a place where people buy and sell shares of companies. A share represents a small piece of ownership in a company. When you own a share, you own part of that business, which means you benefit if the company grows and becomes more valuable. Companies sell shares to raise money to expand operations, hire employees, or develop new products. Investors buy these shares hoping their value increases over time. And some companies also pay dividends, which are portions of profits distributed to shareholders. Stock prices move based on supply and demand. Before a company can be traded on the stock market, it must first go through a process called an initial public offering, or IPO. This is when a private company offers shares to the public for the first time. Private companies are owned by founders, employees, and early investors, and their shares are not available to the general public. Public companies allow anyone to buy ownership shares through the stock market. When a company goes public, it raises money from investors to grow its business, expand operations, and develop new products. In return, investors receive equity, ownership in the company, and can benefit if the company increases in value over time. The American stock market began over 230 years ago with the founding of the New York Stock Exchange in 1792. In the early days, trading was done in person, using paper certificates and hand signals. Over time, the market evolved into the fast electronic system we know today. This transformation made it possible for everyday people to invest and participate in economic growth. The stock market has experienced dramatic periods of growth and decline. The Roaring Twenties saw massive expansion before the crash of 1929 triggered the Great Depression. More recently, events like the dot-com bubble and the financial crisis of 2008 showed how markets can decline sharply. However, history shows that markets have consistently recovered and continued growing over the long term. Volatility is normal, and understanding this is key to staying invested. Over long periods, the American stock market has historically returned about 7 to 10% per year after inflation. This is where compound growth becomes powerful. If you invested $1,000 per year for 30 years at an average return of 8%, it could grow to over $100,000. The earlier you start, the more time your money has to compound. Even small, consistent investments can grow into significant wealth over time. The stock market is not just a tool for professionals. It's one of the most powerful ways ordinary people can build wealth and participate in economic growth. The key is understanding how it works, staying consistent, and remaining invested for the long term.